Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. While 2024 was a fantastic year for stocks and bonds, the housing market has fared less well. Instead, 2024 was the year that gravity caught up with home prices. They've stopped rising nationally for the most part, and certain once red-hot cities are now starting to see clear declines as inventory surges. Will prices start falling from here nationally under today's higher for longer mortgage rates, or will the housing market prove more resilient as we enter into 2025? To find out, we'll talk with real estate analyst Lance Lambert, former real estate editor for Fortune and now co-founder and editor of ResiClub. Lance, thanks so much for joining us today.
Thank you for having me, Adam. Housing. There is always so much going on, and especially right now. We're in this period where, with affordability, when you take into account incomes, home prices, and mortgage rates, this is, the second worst period for home affordability going back to the 70s, right? And really, the only comparable one is like the early 80s. And that's taking into account home prices, incomes, and mortgage rates. But if you add in things like property taxes and you add in insurance, John Burns' calculation shows that actually we are really close to the worst affordability ever for the US housing market. And another factor there is back in the 1980s, if you bought a home, a huge proportion of your payment was the mortgage rate, right? If you were financing. And over time, as rates came down and you were able to refi that payment got to be smaller and smaller proportion of your income. If we don't have that backdrop play out for the macro side with rates coming down a lot and the ability to refi that much, that payment relief won't be there. And then the other factor is if you were somebody who was like, you know what, I'm not going to finance, I'm going to go buy this house outright with cash. Well, because the price to income ratio was so low back in the 80s, some people could do that, right? Whereas today, if you decided, you know what, rates are too high, I'm not going to finance, I'm going to buy this outright, you don't really have relief because prices relative to incomes are so high. So I think this affordability squeeze that we're in is very historic. We're in an interesting chapter for housing, and that affordability squeeze is being felt. And it's being felt in a few different ways. The first and the most immediate was that back in 2022, existing home sales pulled way back. Because one, a lot of that, housing demand that was rampant during the pandemic boom pulled back as rates went up. But the other factor there is that there is somewhat of a lock-in effect where people who have a 2-3% mortgage rate don't want to go get a 6-7. And it's not necessarily that they don't want to. It's around half of homeowners today, and it's actually above, but I don't want to give a number that's too high, but it is over half, could not afford to buy their current home at today's mortgage rates given their income. They wouldn't be eligible for it. So a lot of the lock-in effect is not just that they don't want to lose the rate, it's that they're not even eligible to, because that affordability shock is so big. And so the existing home sales has pulled way back. And, we've had constant forecasts from the industry saying, okay, the worst is over. That's going to start to rebound. It hasn't really happened. And so 2023 was the worst year for existing home sales since 1995. This year will be the worst again since 1995, a little worse than 2023. So that rebound there that people keep talking about hasn't really come for the existing home sale market. Now, when it comes to prices, it's been a little bit of a difficult story and a lot of bifurcation. Because at the end of the day, housing and prices for any good or asset is about the supply-demand equilibrium. Demand pulled back a lot, but in some of these markets, the supply had not necessarily came up, right? And so you can have a supply-demand curve where the demand comes way down and maybe the price growth decelerates, but it still stays positive because of where the equilibrium lands. But over the past, and I'll pull up the data in a second, over the past couple of years, some of these markets have finally seen active inventory, which I really consider the proxy for the supply-demand equilibrium, rebound up, right? And it's not necessarily that there's a lot of new listings coming in the market because there is still that lock-in effect that's holding churn back, but it's the fact that what's coming on isn't selling as fast as it was before, and isn't getting absorbed by the marketplace as quick as it's coming on. And so the active inventory is slowly beginning to build. And if you're fine, I'll go ahead and share my screen to show a rundown of that inventory picture. So every month to my ResiClub Pro audience, my premium readers, I send out an inventory tracker update for 800 metros, 3,000 counties. And what it shows is that pretty much everywhere across the US, with maybe a market here in Dakota or a market there in Nevada, active inventory is up year over year across almost the entire country.
Wow, it is. We talk a lot about real estate being very local and different, but this is kind of a universal trend that inventory is up.
Exactly. Yes, actives are moving up. Now, and this is for the metro level here. And then now this cut of the data is where we are now for active inventory versus 2019. And what you will see is that there's still a lot of the markets in the Northeast and the Midwest and some pockets of California that are still below pre-pandemic levels. And this is a metro one, and I'm going to click my interactive. And all of these are interactive for my pro members. So you go into it, and you can see here, like this is all, well, Austin gets talked about a lot. Everybody knows that Austin has softened and weakened and gone into correction mode. But let's take a look at Dallas. So Dallas right now has 25,000 active listings for sale. Last year at this time, it was 18,000. The year before, it was 17,000. And then at the height of the overheating and pandemic housing boom, there was only 7,300 homes for sale. And that market now is above pre-pandemic levels. So back in November 2019 and November 2018, which I consider great proxies for like a normal market, it was 22,000 listings active, and now it's 25. And on a year over year basis, it's still rising. So we don't exactly know where the actives are going to get to. And so the markets where active inventory has gotten above pre-pandemic levels are the markets where it's feeling a lot more balanced, or even, dare I say, buyers markets. Even though active inventory in terms of months of supply has not gotten to the industry standard of 6 months, you don't necessarily need to get to 6 months to be a balanced or buyer's market. Those are just rules of thumb. They're not necessarily hard set rules. And so you have a market like Austin that's only gotten to 5 months of inventory on the market. So what that means is the amount of inventory on the market in Austin, if it all sold at the current sales pace, would sell within 5 months. So that's what they mean by months of supply. It's only gotten to 5 months, and home prices as measured by the Zillow Home Value Index, as of today, I just got the fresh data, are down 22% from peak in Austin, even though months of supply has only gotten to 5. And home prices in Austin were falling back in summer 2022 when months were only at 3. But the real signal there was the trajectory, the velocity of the inventory growth, because from spring to summer 2022, Austin went from 2 weeks of inventory, not even 1 month of inventory, 2 weeks of inventory to 3 months very quickly. It just shot up. And that was essentially like, almost like, think of it like as having a fever. We were overheating, we were in the frenzy. The fever broke really fast in Austin. And so the question here is, why have you seen more softening in the Gulf and the Sun Belt and the Mountain West than some pockets of California and some pockets of the Northeast and Midwest? And I think a lot of that comes down to elasticity. So housing, unlike a lot of other goods in the economy, demand is much more elastic than supply. Housing has one of the least elastic supplies of any good. Think about it like this. A lot of the housing stock is from the 70s, 60s, 40s, depending on where you are in the country. There's even homes 100 years old, right? So that housing stock is growing like 1% a year. It's very slow. And so the Fed estimates that during the pandemic housing boom, during that period of all the stimulus money, the ultra low rates, work from home, the demand for more space as roommates decoupled because they were working from home, sick of each other, and had some money in the bank from, stimulus or whatnot. All of that increase in housing demand during the pandemic housing boom, the Fed estimates for supply in the new construction market to match that increase in demand, housing starts would have needed to increase 300%.
Hmm.
300%. That's not possible, right? So housing demand can move much faster than supply. It's much more elastic. And so what we had occur during the pandemic housing boom is that elasticity and demand was really flexed in a way that I've never been alive for, right? It's never
Mhm.
moved that quickly, that fast for demand. And it soared up. And so and the supply could not respond. And so we overheated for prices. Well, the reason that matters is that now we're in a place where some markets do have greater elasticity for supply. And those are the markets where there's a lot of home building, right? And a lot of that is in the Sun Belt. And so we are now starting to see that supply elasticity come into effect, right? That all of that supply on the new construction side has come in.
Yep. Hey, Lance, can I just ask one question for you
And
to
I'm getting
input?
long-winded and I'm going to get to it
No,
and then it all makes sense. But
yeah,
yes,
no, this is great. I just want to add one point for you to
yes.
integrate into your continued answer here, which is those Sunbelt states, you're right, that's where the developers were concentrating. That's also where we had, I believe, correct me if I'm wrong, we had the short-term rental markets really explode, and we had a higher percentage of institutional investors buying into the single-family home market. Is that the case?
Those are all components of it, right? And where you can kind of see that part of it and the greater overheating is on prices. A lot of the Mountain West and these Sunbelt markets, Austin, Tampa, Boise, Phoenix, these were the markets that saw greater appreciation during the pandemic housing boom, right? And so that created a problem for those markets because they then got more strained on fundamentals, right? And then at the same time as that kind of ended, their migration that was coming in, that pandemic migration, decelerated. People are still moving to Phoenix. People are still moving to Austin. People are still moving to Florida. It's not like it was before during the pandemic. And
The
so,
rate of change was slowing, yeah.
exactly. And so, what and why that matters is that then the housing market in those places becomes more reliant on the local incomes. And they were then more stretched because they had greater overheating during the boom. So that's where you see that part of it. And so you have that element come into play where there's a greater demand shock because that migration decelerates and a greater demand shock because the market had to rely more on local incomes, which were more out of whack with the pricing. And on the other side, these home builders with this new construction supply, that was coming into the market. And we just heard on the earnings call today with Lennar, and today being November 19th, the CEO said, Stuart Miller, said that they, where and when needed, they will make adjustments to continue sales pace. And so what that means is builders are saying, we're going to continue to sell the same amount of homes. We are going to continue to move this volume. And so if they have to do it where and when needed, they will cut prices, make affordability adjustments to do it. And so builders have done that in a lot of these Sunbelt markets and boomtowns, pandemic boomtowns now. And so as they do that, that draws the interest of some of the buyers, home buyers, who would have otherwise looked at resale and existing homes, right?
Mhm.
They would have liked those homes, but they're too high a price. The existing home seller doesn't want to come down, but this home builder, they're going to work with me, right? A little bit more. And so that's drawing the interest of some of these buyers from the existing resale market to new construction. And as that occurs, the days on market and the active inventory in the existing and resale market in those Gulf markets and Mountain West markets increases, right? And so it's a long-winded explanation, but those are the factors that come together. And unlike the Sun Belt markets, the Midwest and Northeast markets in particular They didn't have a lot of the pandemic migration. They were actually losing some of the people because of the pandemic migration. So because they didn't have that, they didn't get hit by that particular demand shock. Some of them didn't necessarily overheat as much as their Mountain West and Sunbelt market peers. And then they also do not have that new home construction on the same percentage basis as the Sunbelt markets. And so because they don't have that side of the new construction doing as much of the discounting, the existing and resale sellers are still pretty much the only game in town, and they've maintained relative power to the sellers compared to the sellers in the Mountain West and Gulf regions.
Okay, great overview. I want to give you kudos too for when you were on a year ago giving your 2024 outlook. You did call for an increased bifurcation of the housing market. I think you've just walked us through exactly why we've seen that. The reason why I brought up the institutional owners and the short-term rental owners, and actually, I guess we can probably just put general mom and pop landlords in there too, because they all kind of went hog wild during the COVID stimulus era. So I totally get why in those markets that did overheat, that new home building was a big factor, is now a big factor in what's going on there. How much of a factor in what's going on there today is institutions saying, you know what, uh, this isn't cash flowing the way that we thought it was, and so let's just get rid of it, right? Because for them, it's not the roof over their head. They're very light hands in terms of, oh, it's not working for us, let's sell it. Similar thing with the short-term rental market, right? Where people were brought in at the siren song of I'm going to get rich on passive income. In a lot of places, that's not playing out anymore. Again, it's not the roof over their head, so they'll say, look, I want to dump that on the market too. Is that a factor at all? And if so, if you had to kind of give rough percentages to why there's price pressure in those markets, how much is due to the new inventory versus the institutional and the short-term rental selling?
Yeah. So what we have seen on the institutional market is that during the pandemic housing boom, we had a big influx of institutional home buying into the housing market, right? Now, on a percentage basis, it wasn't like a huge, crazy percent nationally, although in a lot of these Sun Belt markets, Tampa, so these six markets I'm going to list are home to 36% of all institutionally owned homes. Atlanta, Dallas, Houston, Phoenix, Jacksonville. Okay, I'm going to go through it again. Tampa, Atlanta, Jacksonville, Houston, Dallas, Phoenix. Those six. Those six markets are home to 36% of all institutionally owned homes. And what we saw during the pandemic housing boom is that in the capital market side, there was a lot of liquidity, right? The Fed was buying up a lot of MBS securities, treasuries. That pushed a lot of money into the financial markets, right? The financial markets needed a place to deploy it to get returns, right? And one of the places they went is not only multifamily, but also single family this round. And so during the pandemic housing boom, we had a tremendous amount of capital in the institutional markets deployed into single family housing. That was occurring both from scatter site buying, and that was also occurring from build to rent. So right here, I have a chart of American Homes for Rent. They're one of the largest institutional home buyers in the country. And if you see this very dark bar, and I don't know how easy it is to tell the difference between the reds here.
We can see them.
This dark red is scatter site buying, pretty much bought through acquisition. Roof stock, and maybe I shouldn't. I was recently told. Actually, they said it on the record. Roof stock at Resi Day, a conference that I did in New York City back in November, that American Homes for Rent has not bought a single home off the MLS in 2 years, is what they said. And if you look at the numbers from the scatter site buying and their earnings reports that I pull monthly, it has went way down since rates went up a lot, right? And this is true across institutions. Invitation homes, you could just go on and on through them. Amherst, they've really pulled back on the amount of homes that they're buying scatter site. And what scatter site means, that's kind of like they come into your block, a home's for sale, they bid on it, they buy that home, and they manage it as a rental, right? What they are still doing and really took off during the pandemic housing boom is build to rent. And that is still ongoing. It's not necessarily as much capital getting deployed as it was a few years ago. I was talking to a lender recently who was in a lot of meetings with institutions who were deploying a billion plus for build to rent. There's still institutional capital coming in, and he expects long term, that market to stay around, but it's not as much of the $1 billion deployments, right? But it's still occurring. And so American Homes for Rent, they've really turned their eye to build to rent, and they have created their own in-house home builder. And it's actually the 39th largest home builder in the US right now is American Homes for Rent. So the 39th largest home builder in the US is American Homes for Rent, and they do not sell it to any home buyers. They just keep them all as rentals. And so they are still selling some homes. You'll see here's the dispositions. They're selling more homes than they were during the pandemic housing boom. And a lot of these are scatter sites, right? Are getting, and so it's not like a massive sell off, but you are seeing a good number of these institutions be net sellers in any given quarter right now.
Right. And that's kind of where I was going, which is, housing is priced at the margin, and you've got a guy who used to be a big buyer, who or a class of buyers that used to be big buyers, who now are not only not buying anymore, at least not buying to own, or to sell, but now they've really ramped up their sellers. So not only not buying, they're net sellers at this point.
Yeah, and I think the impact there is more acute, not even at a market level as much. It's really a zip code level. So I teamed up with Parcel Labs heading into this year, and we were analyzing the portfolios of different institutions. And Vinebrook, uh, they had some issues with liquidity that they noted in an earnings report, that they needed capital. And so they offloaded, I believe, don't quote me on it, I think it was around 2,000 homes, but they were very concentrated in specific zip codes. So we found in some places like Milwaukee and Cincinnati, which you don't really get talked about as much as like institutional markets, 35 to 40% of all of the active inventory in some of those zip codes in Milwaukee and Cincinnati earlier this year were Vinebrook listings. So the impact from some of these institutions on a macro level for the total US housing market might not be that big, but on a very regional level, down to like the actual zip code, it can have an impact. And we did see that those zip codes that had a lot of that rushed inventory, prices and rents were falling.
Yeah. Okay. And this is something that I've mentioned on the channel numerous times in the past, and brought up with other housing folks on here, which is one of the dangers of institutional housing, institutional buyers, and I also think the short-term rental buying is uh, one of the dangers is they'll come into your market, and all of a sudden it's really hard for people to afford, regular families to afford to buy a home, because these deep-pocketed folks are outbidding them. But also, if things turn, these guys can start dumping a lot of inventory on the market. And if you're a homeowner hoping to sell your home at some point in the future, these guys can really crater bidding prices, because they're pumping a lot of inventory onto the market quickly. Lance, I'm just curious on the short-term rental market, similar dynamic, meaning was a net marginal buyer pushing things up, back during the pandemic craze, but is it now a net drain?
Well, I think with short-term rentals, the thing that we saw there is that housing, the the demand for short-term rentals soared during the pandemic, right? Everybody knows the story. People are working from home. There's a lot of stimulus sloshing around. They can be anywhere, and a lot of people took this as an opportunity to, rent out short-term rentals for a week here, a week there. You could not go on cruises. You could not do international travel. There was a lot of people who didn't want to be clustered in really big hotels, right? Because of COVID-19. And so huge demand for the Airbnb rentals. At the same time, the prices of homes are soaring. Interest rates are very low, making cash flow enticing. And so there was a big rush to buy properties and make them short-term rentals, right? And the daily rates, as that demand was soaring, just took off, right, during the pandemic.
Mm-hmm.
Well, we have since the past 2 years gotten to the other side of that, where a lot of the factors that rushed up Airbnb short-term rental demand have decelerated, right? Some of them outright pulled back in some markets. And at the same time, a lot of that supply of those homes that were being bought, remodeled to be Airbnbs, has come into the marketplace. And so daily rates have been in a correction mode in a lot of markets for short-term rentals for the past couple years. And overall revenues for Airbnbs, I forget the number, it was declined like 14 of 16 months on an aggregate level. And so we have seen on a regional level uh, corrections for short-term rentals. And I think a lot of that varies. You'll go through parts of East Tennessee around like Gatlinburg area, right? And there have been, falling prices for specifically certain parts of the short-term rental market there, right? Like on an aggregate level, some of those counties in East Tennessee are outright down from peak, like 7%. But some of the short-term rentals in certain price tiers have been hit more. Now, there are some of the higher price tier ones there that have gotten like bigger remodels and demand has been more stable. But big picture, things have been fairly choppy in the short-term rental market for the past couple years. And you will always have, when you have a rush of people into the market, you will have some realize, what did I get myself into? I don't know what I'm doing here. This is taking way more time than I thought I was. I'm not making anywhere near the amount of money that I thought I could. And they exit from the marketplace and sell that. And unlike, maybe some of these homes that you would purchase uh, that could also be rentals. These ones, some of them are very specific to Airbnbs, right? And so then you're trying to sell a home that is very niche. And that's where you get into the problem where you saw in like Palm Springs, California, right? Where, and I think it's Palm Springs, right? I believe that's right, where some of those areas uh, outside of the Gulf or further from the Pacific, there were really tourist destinations where a lot of the properties were short-term rentals. That's where they've seen more correction.
Oh yeah, a lot of horror stories coming out of Palm Springs. I live in California, so I hear them. All right, so kind of the dots I'm trying to connect here, Lance, is we've had we've had these issues going on where we've had these reversal of trends since the COVID buying boom, right? Buying bonanza, and you've just laid a bunch of them out for us. People's migration isn't on fire the way that it was when everybody could work from home and now live wherever they wanted to, and they had stimulus checks and all right, screw you, roommate, I'm going to go get a place of my own type of deal. So that's all over. We now have continued inventory from these builders rolling into the markets where the builders were most heavily saturated. Those builders are now having to basically offer buying incentives now, right, which is stealing demand from the existing home market, right? We have the institutional buyers now becoming net sellers. We've got the short-term rental people, now in the hangover stage and saying, I don't think I want to be in this anymore, right? So we have all those factors going on. Now, somebody could look at the map you showed and say, yeah, but those are really mostly concentrated in those sunshine states that went crazy. So for someone who's in the rest of the country where it was pretty brown, on your map, they might be thinking, so I don't got to worry. The inventory is still low. It's going to keep the value of my house up here. I should be just fine. Nothing to sweat. Or does the factor of what you were talking about earlier of the unaffordability start to kick in, where you've had people that are now kind of trapped in their homes, right? They can't afford to move. In fact, they might not be able to qualify to move and buy the type of house that they want. And the longer time goes on, the longer that mortgage rates are higher for longer, and I just want to make sure we underscore for folks, the Fed has dropped its policy rate by 100 basis points. Mortgage rates are higher since it started, but not lower. So the longer we hang out here, you just have the organic life issues that force people to start having to sell, right? They get divorced, they lose their job, or their job forces them to move, or whatever. People die. Um, that starts to begin to force inventory on the market in these spaces. And so, since people are having so much of a hard time, or yeah, while cost of living and uh, cost of mortgages and whatnot, cost of homeowning, sorry, the all-in cost of homeowning, not just the mortgage, but the property taxes, the insurance, the maintenance, everything you mentioned earlier. Does that begin to act like gravity in all markets that begins to force more and more inventory onto the system? Because my sense here is under these current market conditions, more inventory pretty much eventually means lower prices.
So a couple things there, and I take this as you're asking about some of these markets that have stayed tighter, right? Like the Midwest and the Northeast.
Right.
Like, are they
Do people in those markets need to worry about lower prices? Or are they
yes.
safe for next year?
So the thing that I would expect is I believe that I think that a lot of the Northeast and a lot of the Midwest, because of where the supply demand equilibrium is right now, although they finally got a little bit of inventory growth in some of those markets this year, but I think the technical still right here as we are about to approach the seasonal period where there's that seasonal bit of upswing. I think that home prices will probably rise in a lot of the Midwest and Northeast, but that does not guarantee that that will continue and that there isn't potentially a period where prices could fall. But I think what you would need to see to work to that is you would need to see active inventory next year, even if prices were to rise, for active inventory to also be rising. And then if you could get to a level where the supply demand equilibrium's in a place where there's a good amount of supply relative to demand, maybe we could have that discussion. But I also think there's a possibility where prices rise again next year in the Northeast and Midwest, active inventory rises with it at the same time. And then we finally have a period where the Northeast and Midwest go sideways for a long time with this really strained affordability, right? As the
Mhm.
market tries to heal and it could heal sideways. And it is true of the history of the Midwest that even in like the late 80s into the 90s, when California and some of those markets fell, the Midwest went more sideways, right? And so it is possible because they get less of the influx from everywhere else that they could potentially go sideways. But the big wild card here, I think, is less of like people finally being like, you know what, I got to sell my home and that churn coming back being the thing that drives prices down. I think the bigger wild card is what happens to the economy in the Northeast and Midwest the next couple of years. If it stays in a place where it is fairly resilient, that could more likely be the scenario where the Midwest and Northeast go sideways. That's kind of where I am right now. So short term, I think there's a little more upside short term Midwest and Northeast just because they still have those tight technicals and they don't have some of the headwinds on demand like the Southeast, Southwest, and some of the new construction supply that those markets have. And so I think the next year, I still think prices up a little higher, Midwest and Northeast. But if, depending on where active inventory can get to by this time next year, and depending on where the job markets in those places go, we could be having a different discussion.
Okay. And it makes total sense. So goes the job market. Oftentimes, so goes housing because mortgages get paid with incomes. And if no people start losing their income, that compromises their ability to pay their mortgage. I think there's an interesting debate playing out right now with the unemployment rate where it has started to increase, right? It has bottomed. And historically, when you look at the unemployment rate, when it bottoms, and this isn't not in every case, but in almost every case in living history, um, it once it bottoms and starts increasing, it then spikes into another recession. And so something would have to be different this time in the economy to explain why we don't end up having that destiny. And a lot of people are debating both sides of that. We don't need to get into that here, but obviously, if it did follow the historical pattern and unemployment were to spike up to say, 6, 7% or whatever, I would imagine you would be a lot more pessimistic about home prices everywhere. Um,
Exactly.
yeah,
Given the affordability backdrop and the fact that we just went through this huge boom for housing, right? That
yeah.
puts us in a period of some vulnerability to that type of downside risk.
Okay. So even if the unemployment rate doesn't move dramatically, say in the next year, it seems from the data that I've seen, and really more than I've heard from some other mortgage analysts, um, we're starting to see delinquencies start to pick up. And we've seen them in other debt classes first, credit card debt, auto loans. But now I'm hearing reports from mortgage analysts that they're starting to see, um, some concerning increases in delinquencies in some cases, not all, in some cases, along the order of magnitude that we saw in heading into the last housing bust. Um, how much are you watching and worried about that?
Yeah, so I think the increase is there and they're, they're slow, like there's something there. You're right.
Yeah,
It is starting to occur. I think it's something to watch heading out, not necessarily for 2025, but that's like a long-term story for the economy, like of things that we should be watching, like what type of macro setup we could get into in 2028 could be very different than the potential for 2025. If the next few years those continue to move up, right? That 2028 type of downside risk for the economy and housing could be very different. So it's definitely something I'm watching. And I think that the thing you brought up there with unemployment, that really is the big thing, right? Because it's slowly kind of coming off the cycle lows of 3.4. We've now gotten up to like 4.2. And so it's a question of where does that go the next 12 months? These analysts and a lot of people across the financial markets, Goldman Sachs, you even saw in the Fed report this week, a lot of them think that unemployment rate is going to stay around like 4.3, 4.2. But is um, all it takes is a clear deterioration in the labor market, and everybody's tune will change across all of financial markets. So I really think that it really is the key, is where does the labor market head? And so I'm closely keeping an eye on jobless claims, closely keeping an eye on the unemployment rate, just like everybody should be. And I also think they should be keeping an eye on regional unemployment rates because
right.
it's possible that a deterioration could start in a regional pocket and then, everybody else still be good. And then, the
Right.
break.
Well, if you live in an area where one big university or a big factory or something like that employs a good chunk of the town and that falls on hard times, doesn't matter what's happening in the rest of the economy, that town is suffering.
Yes. And so people get mad at me sometimes because I've said over the past, and I keep saying it, that the labor market so far has been a tailwind for housing. Not that there aren't headwinds, but there are huge headwinds in housing, the affordability. But really that labor side, that tailwind is kind of what's kept up some of the prices, allowed the market to kind of stomach some of this affordability shock. And so if that story were to change, I think a lot of people's tunes would also change with it.
Okay. Well, it's
And,
it's
and by
interesting.
the way,
Yeah.
and I'm not a labor market expert, so I don't know what like the likelihood of that change would be, what would be the dynamics to kind of set that up. But if it were, that's where there would be a potential hit to housing.
Yeah. And I think this is where folks like uh, Michael Kantrowitz or Eric Basmajian, who spent a lot of time looking at the labor markets and breaking it down into component indicators, which ones are the leading ones, which one are the lagging ones. Um, if you're really interested in this topic, folks, those are good analysts to go follow. And you reminded me I got to need to get at least one of those guys on the program relatively early in 2025 to get their 2025 outlook for where they think the employment market's headed. But let me ask you something.
Can I ask you
Oh yeah,
something to them?
yeah,
I want to share a chart.
yeah.
So this is the number of unsold completed homes in the US. So these are single family homes that builders have completed and they haven't sold. And we have moved up from the cycle low during the overheating when everything that was available was getting absorbed by the market. We've gone above pre-pandemic levels, and then we've shot up even higher. Now we're
Mhm.
not at like the '07 levels, right? There's only 118 or 113,000 unsold completed new homes. But I think this is something to watch because
I would
one of
agree.
one of the
It's the highest outside of in this data set outside of the bust in 2007.
one of the real resiliencies for the entire economy has been the fact that one of the rate sensitive parts, one of the most rate sensitive parts, let me see if I can find it here, residential construction, in terms of the economic output. Yes, the mortgage side has come down a lot as transactions have come down. Yes, realtor commissions are down, all of that. But in terms of the real economic impact of housing, that's residential construction, right? And we've still seen a lot of completions, very high level completions. And residential construction employment is at cycle highs. And you usually, if you go back here into the 80s, you see it rolled over before the recession. You see before the tech bubble burst, it was rolling
Yeah.
over. And of course, most famously, before GFC, it was rolling over. So if this unsold completed inventory continues to build, right, and then builders to move some of it have to come down more on their margins and compress, and then as they do that, that also creates more of an incentive to pull more buyers from the existing market over to new.
Right.
And in the existing market, that inventory mounts again. That creates more pressure for the builders. If that can happen, does that finally, especially as we also roll through this huge amount of multifamily inventory that is falling? I mean, if you look at multifamily housing starts and permits that are further back that are leading, right? Multifamily completions are eventually going to roll over. We're at like the high for the cycle for that. And so as that occurs, do we finally get more downward pressure from residential construction on the overall economy, which so far, even though given rates and everything, has not created that much downward pressure on the economy from residential construction so far.
All right. Let me ask you this, Lance. So how much of this do you think is, in other words, sort of cycle high for construction employment, is from legacy projects, right? Which is this was just all the stuff that was in the pipeline, right? And a half-built house has no value to us. So let's get all this stuff done. But eventually, the flow coming through the pipeline really starts to trickle
I
at
think
some point.
I think it's two parts. The first part is your narrative there of like a lot of the existing pipeline is absolutely true for multifamily, right? And we have seen the starts and permits for that already roll over. So completions for multi is going to roll over. And as that occurs, you probably need less workers in multifamily, right?
Right,
For
right.
single family, it's a little bit different because the sales volume, although we're off the highs, has been fairly resilient for single family. And the reason is builders were able to compress margins a bit, do the affordability adjustments and price cuts to keep that going, right? But the question there becomes for single family as this unsold inventory rises, and you heard from Lennar recently that they think margins will compress even more Q1 2025. As that occurs, do they finally reach a level where the sales volume pulls back more and then economic activity? Because right now, they've corrected more on price and affordability through their adjustments and compressing the margins than they have actually on activity and sales.
On supply, yeah.
And then if that occurs, I think that still takes time to kind of play out. But again, if other parts of the economy weaken faster than expected, things can slow down much faster than the current trajectory, right?
Got it. And let me ask a question related to that. It's the one I was going to ask earlier. So, part of your commentary there is, construction spending is a big supporter of the economy, the local economies that it happens in, right? And right now we're at a cycle high, right? Let's assume for a second that President Trump is serious and successful about deporting millions of undocumented / illegals here in the States. There are a bunch of them who are working, and a lot of them work in the construction industry. Do you think that would have any material impact on this story if suddenly a million plus, millions of them say, hey, I'm I got to leave the country or I'm being forced out of the country?
Potentially. I don't know in terms of the economic impact. I don't know how acute the economic impact from that would be. I think the economic impact of, them overall leaving their consumer spending, like maybe that's more so economic impact.
That's sort of where it was going. And also too, I mean, if the builders can build
Well,
less homes because they have fewer crews, that's another issue
and
too.
then the other part there is it could potentially, right, depending on where the overall economy is, put upward pressure on the labor spend of residential construction, right? Fewer people left, they're able to demand more earnings. That further compresses builders' margins, right?
It depends if the prices go up faster than the employees they're losing. But yes.
Exactly. And so there's so many secondary and third effects that it kind of gets a little hard to intuitively be like, this is exactly what would happen. And that's why I go back to what would also happen to the overall economy there in that place. But so I think right now there's a lot of uncertainty, is how I would describe it, right? Like, what is actually going to happen to the fiscal side of the economy? If we are in a place where maybe Trump leans in more to, hey, let's attack, like with the Doge stuff, let's attack the long-term trajectory of fiscal spending. That could have an impact on um, long-term yields and maybe even mortgage rates to
I
lower.
mean, everything, but yeah.
Now, if they go the other route and it's like more of like, the tariffs, which could put upward pressure on consumer spending, or, maybe the deportation aspect, that could have a very different effect, right? So I think there's a lot of uncertainty right now in terms of, the trajectory of federal government priorities. And then, if you go back and you look at what did Trump do in the first term, right? Well, tariffs were increased on places like China, but a lot of the other tariffs were just talk, right? Some of them used as negotiating ploys. And then in terms of like the immigration, you did see a deceleration in terms of the people coming in the country, but you didn't necessarily see a huge uptick in the number of deportations, despite what was kind of talked about. And I think that's true across parties and across political affiliations, right? There's the things the candidates say, and then there's the things that actually occur.
One last question about illegals. There's been much debate over their impact on home prices. On one end of the spectrum, people would say, hey, you've got, tens of millions of people who've come here and they're pushing up demand for housing because bodies need shelter. And then I think on the other end of the spectrum, it's like, hey, do you really believe that these folks who are working under the table are out competing, boomers that are trying to buy their next McMansion? So, what impact, if any, do you see to date the illegal population having on the U.S. housing market?
Yeah, so we saw a pretty big influx in terms of like the number of undocumented people coming in 2021, 22, 23. And then I was just looking at the new estimates from census. They expect a much bigger number for net immigration for 24 than I thought it would be. And so more people than expected, that's more demand for space, right? At the end of the day, people are housed in America, generally speaking. There are some homeless people, but almost everybody lives in housing, right? And so if you have more people than expected living in housing, more demand for housing, it goes back to what I said earlier. Housing demand, and this is true for rental, this is true for purchasing market, is more elastic than supply. Well, 10 more people coming, whatever million number coming in more than expected, you didn't have a supply response immediately for that, right? And so that's absorbing rental vacancies potentially. Now, rental vacancies are on the rise because of all the multifamily supply,
Mhm.
but it could also be the case that multifamily vacancies, even though they're rising, could have risen much faster, and we might have had more normalization for some dynamics throughout housing without that big influx. So I'm not, one of the ones in the camp of, we have millions more come in than expected. That has no impact in housing because that's not really how housing works. But in terms of like, was it the overall driver of the pandemic housing boom or rental inflation? No, because we can go and look across the global world and see that we saw an overheating, right, for home prices, for rents. But did it play a role there? I'm in the view it's had an impact. People, or they have they're housed right in the U.S. And so I think vacancies for the rental market would have been higher uh, in the scenario where it didn't occur.
All right, Lance. Well, look, I could go for another hour, but we're coming up on the hour here, so I got to give you a chance to get on to your work and to your holidays soon because you're kind enough to come on right before Christmas and record this here. Um, I guess last question I have, and then I'll let you wrap up with any sort of parting bits of perspective you want to offer. Um, what what counsel would you have to um, people that are thinking about perhaps selling their home in the next year or two, and people that are aspiring to buy a new home or buy a home in the next year or two?
Yeah, I think the place to think with housing, and this is probably true across a lot of cycles, is that the longer your horizon, the less risk of the decision, is my view of housing. Now, there are definitely instances where that gets to be a little sloppy, right? If I said that to somebody in 2007, right?
Mhm.
That horizon would need to be really long. And the opportunity cost could be fairly high to that. But I think in this housing market with a strained affordability where it is, that does put some potential for downside risk. And I think the longer people's horizon, the longer you're planning to live in a house, if it's 8 years, 10 years, that's where that downside risk to personal impact to you is likely lower. And it really, a lot of that is coming down to assessing where is your job security? Where is your income security? Where is, and this is the least talked about part of housing, but one of the most important parts, your relationship security. All of those things, and like, are you buying in a place that you expect to be in 5 years, 10 years? Those things all are really big things to assess. But in terms of like the short term, like you are going to buy and you're going to plan to sell in 24 months, 36 months, because you could relocate, that's where I think I personally would start to assess things a little differently.
Okay, and just to be clear, when you talked about assessing your relationship security, is that sort of like, okay, like how healthy is my relationship with my partner right now? Because if I buy a house with them, but we're kind of in a rocky state, and then we decide we want to separate, that's going to play a big factor.
It's not something that gets talked about a lot, but yeah, it's where people get in trouble with housing is a lot of that D. And that's the D that creates some inventory that creates opportunities for buyers in the market. It creates opportunities for investors in the market. Yeah, I mean, it's a harder topic to discuss, but yes, I think to have that type of like assessment of yourself, and it's not just an assessment of where is housing right now is where I would do. That's what I would do if I were personally considering buying or selling in this market.
All right, no, it makes sense and very important. And
And
I'm just
any
chuckling.
really in any market too.
Yeah. I'm just chuckling because my wife, as my viewers know, is a marriage family therapist. And I'm thinking, oh, maybe there's some business idea out there where, you get some real estate professionals connected with a bunch of therapists and, okay, these couples look like they're not going to make it. So here's the real estate opportunity that could come out of that. My wife would shoot me if she heard that idea.
Well,
But
so I've heard from realtors situations where like one of the big problems for like some of the recent divorces are like they have a very low interest rate. They're going to have to sell this home, and then both sides are going to have much higher monthly expenses for housing. So it definitely plays a role for
yeah, well,
housing.
I can tell you there's a real, I would call it an epidemic of people who want to divorce and maybe they've already separated, and maybe even some of them have actually gone and got the divorce, but they're still living under the same roof because they can't afford to live apart.
Yeah.
All right. Well, great discussion, Lance. Thanks so much for coming on and sharing so much of your outlook for us for next year. And it sounds like it's not that grim. Overall, it sounds like you think that there are, a fair amount of markets in the country that probably may still see some price appreciation, and obviously some of those markets we talked about that have much more competition going on, they're probably going to continue to have some pain for the foreseeable future. All right. Well, look, I'm glad you got a chance to walk through a few of your interactive charts, but I mean, that's just like scratching the surface of the iceberg when it comes to ResiClub and your ResiPro service. So for folks that are really into real estate, really enjoy your analysis here and would like to follow you and your work between now and the next time you come on this channel, Lance, where should they go?
Yeah. If you'd like to follow my work, go to ResiClubAnalytics.com, or you could just Google ResiClub and click on the first link. And when you're there, put in your email and you can get signed up for my free newsletter. I do articles several times a week, looking at power dynamics for buyers and sellers across the country, looking at home building, all of these different components of the housing market. And then I also do 3 additional research articles per week for my ResiClub Pro members. That's my paying audience. I do an inventory tracker and a price tracker every month for 3,000 counties in the US. And that's something I offer for the premium members who upgrade.
All right, fantastic. And it's a great service. All right, well, look, folks, if you enjoyed having Lance on the program today, really found his perspectives and his expertise valuable, please let him know that by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. And just a reminder, buying a house is one of the most important financial decisions that most people make. For a lot of people, it is one of, if not the largest asset that they own. If you'd like some help in wrestling through any decisions around, what decisions you might make with a house, buy, sell, whatever in the future, how that fits into your overall financial situation, highly recommend you have those discussions with a good quality financial advisor who understands the major housing market trends that Lance has laid out for us here. If you've got a good one who can do that, great, stick with them. But if not, or you'd like a second opinion from one who does, consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. To do that, just go to thoughtfulmoney.com, fill out the short form there. These consultations are totally free. There's no strings attached, no commitments, just a free public service that these folks offer. Lance, it's been wonderful. I wish you and your family happy holidays. I'll let you have the last word here. Any bits of parting commentary you want to give to the audience?
Just housing, housing, housing. There's always a lot going on. And if you want to stay up with the in-week moves and daily stuff, you could follow me on X at News Lambert.
All right, fantastic. All right, Lance, have a wonderful holiday with your family. Everybody else, thanks so much for watching.